Welcome to RP Data's update on housing market conditions in Australia for July 2013. Last month we saw dwelling values rise by 1.9% across the capital cities, more than reversing the 1.7% fall over the previous 2 months. With clearance rates remaining high, more buyers in the marketplace and of course interest rates remaining low, potentially going lower, we do expect the measured recovery to continue throughout 2013. The latest June data takes the quarterly growth rate to just 0.2% after the March quarter posted a seasonally strong 2.8% increase. Dwelling values are now 3.8% higher over the 2012-13 financial year. As a comparison, capital city home values fell by 3.6% over the 2011-12 financial year. The quarterly gains were primarily driven by Australia's largest housing market, Sydney, where values posted a 1.2% increase. Adelaide also posted a 1.2% increase in values over the quarter. However, Adelaide values are only 0.2% higher over the financial year. Perth also posted a quarterly rise in values with a virtually flat 0.1% increase. All other cities recorded a negative movement over the June quarter, with the weakest result being Darwin, where the index showed a 2.7% fall. The end of the financial year has seen dwelling values across the capital city boundaries increase by 3.8%. Every capital city across the country has recorded a rise in dwelling values over the year, apart from Hobart, where conditions still remain weak. Outside of value appreciation, we are seeing most other metrics remain very strong. The average selling time across the capital cities was just 43 days compared with 60 days at the same time last year. That's the lowest average time on market since May 2010. Auction clearance rates are holding firm around the 70% mark across most of the major auction markets, which are once again level with the market conditions around early 2010. Listing numbers are running about 8% lower than a year ago nationally and about 14% lower across the capital cities. While stock levels are reduced, transaction numbers have seen a decent rise. The number of home sales over the 3 months ending April was about 13% higher than the same period a year ago. Now let's have a look at how the housing markets are performing from city to city. Sydney is arguably showing the best fundamentals of any capital city, which is evident in the 5.6% increase in dwelling values over the past financial year. Auction clearance rates have hardly dropped below 70% over the past 3 months. Transaction volumes over the 3 months ending April are up about 22% compared with the same time last year, and homes are selling at an average of just 37 days. Rental yields are spot on the capital city average, and rents are up about 3% over the past year, suggesting there may be some yield erosion underway as value growth outpaces rental growth. Melbourne's housing market remains relatively sluggish compared with Sydney. However, dwelling values are broadly rising. They're up 3.4% over the financial year and up by 2.1% over the first half of 2013. Similar to Sydney, auction clearance rates are bouncing around the 70% mark week on week, and homes are selling an average of just 37 days. Transaction numbers haven't seen the same level of pickup as Sydney, with the number of home sales 7.5% higher over the 3 months ending April 2013 compared with the same time in 2012. Local rents have increased by 2.2% over the past year, which has kept gross yields the lowest of any capital city at 3.7% for houses and 4.4% for units. Brisbane's housing market has recorded virtually no growth over the financial year, with values up a paltry 0.6%. Most of the growth appears to be centred around the detached housing market, where transaction volumes are 13% higher over the 3 months ending April 2013 compared with 2012. While off-the-plan sales have been reported as being very strong, the overall unit market across Brisbane remains sluggish, with transactions lower over the year and values down 1.8% over the financial year. The bright spot in the Brisbane market, apart from superior affordability, is the rental market. House and unit rents have moved about 3% higher over the year, driving gross rental yields higher. The gross rental yield on the average Brisbane house is now 4.7%. That's the third highest of any capital city, and the gross yield on an average Brisbane unit is 5.7%, which is the second highest return of any capital city. Adelaide's housing market posted a solid June quarter with values up 1.2%. However, the longer-term result isn't as strong. Adelaide dwelling values were virtually flat over the financial year, with a 0.2% increase in values over the year. Homes are taking an average of 55 days to sell, which is longer than the capital city average, and home sales are up by just 3.5% over the past year. Despite the strong quarterly figure, the Adelaide market remains relatively sedate. Perth's housing market has been a standout performer over the past 18 months. Since the housing market bottomed out earlier than most other cities, values have risen by 9.5%. The quarterly rate of growth across the Perth market recently peaked at 4.3% in March this year and has slowed to just 0.1% over the June quarter. The average selling time remains quite rapid though at 40 days, which suggests buyer demand remains strong. Rental growth remains at high levels, close to 8% over the year. However, the growth rate in rents appears to be slowing down now from a peak of 13% over the year ending January this year. The index for Hobart's housing market shows more volatility than most other cities due to the small size of the market. There were just 3,700 sales of houses and units recorded across the Hobart market over the 12 months ending April 2013, which is about 15% lower than the 5-year average number of sales. The number of Hobart dwelling sales has improved over the year though, with transactions recorded over the 3 months to April 2013 6.4% higher than a year ago. The local rental market remains subdued, with weekly rents down 3% for units and pretty much flat over the year for houses. Hobart was the only capital city to record a fall in home values over the 2012-13 financial year. Darwin's housing market may be entering a transition phase, with the RP Data Rismark Index showing a 0.4% fall in Darwin dwelling values over the first half of the year. The fall comes after Darwin values recorded a solid rise of close to 11% since the market bottomed out in January 2012. Rents have also flattened out over the quarter but are up about 9% over the year. Gross rental yields in Darwin remain the highest of any capital city, with houses and units providing an average gross yield of 6.2%. Canberra's housing market recorded a 1.6% fall in dwelling values over the June quarter, and over the financial year, Canberra values have moved 1.1% higher. The number of house and unit sales has seen a modest increase compared with a year ago. However, the annual number of sales across Canberra is about 14% lower than the 5-year average. Canberra's rental market is pretty much stalled, with rents down 2% for units, while house rents are up 0.8% over the year. Overall, the Australian housing market has recorded a relatively sedate second quarter. Seasonally, the June quarter is typically weaker than the March, and that is certainly the case this year, with capital city dwelling values rising 2.8% over the March quarter, compared with the 0.2% growth rate of the June quarter. As previously indicated, most other market measures remain strong, with clearance rates high, homes selling substantially faster than a year ago, and more buyers active in the market. We've also seen an improvement in housing finance commitments, with the number of new mortgages higher across all market segments, particularly for investors. Dwelling approvals are up 27% over the year, suggesting that developers are starting to respond to the improvement in housing market conditions as well. That's a good sign for the Australian economy, considering the federal budget was looking for a 5% uplift in dwelling investment over the coming year. Importantly, we've seen a lift in consumer confidence in June as well, after confidence levels dipped during April and May. Another factor that's important to note is that despite most market indicators providing a strong reading, the current market conditions are very different compared with the post-GFC recovery of 2009. At that time, there was a great deal of government stimulus with the First Home Buyers Grant boost. First home buyers peaked at more than 30% of all owner-occupier mortgages. Mortgage rates were lower than they are now, even though the cash rate was at a higher level, and value growth was substantially higher during the 2009 growth phase. As you can see from the graph, the current recovery phase is much more measured, even though clearance rates and selling time are strong. Looking forward, we maintain our view that the housing market will continue along its recovery path, with value growth likely to be broadly in line with wages growth. This month's viewer question comes from Jennifer in Newcastle. Jennifer wants to know if her local housing market will benefit from the announcements included in the recently released New South Wales budget. The key takeouts for Newcastle were the privatisation of the state's ports, including the Port of Newcastle, which is the world's largest coal port. The port will be subject to a new 99-year lease, which will fund $340 million to be pumped directly into the Newcastle Revitalisation Project, which includes a new light rail line and ongoing urban renewal of the Newcastle precinct. As with any major infrastructure and urban renewal project, we'd expect this should have a very positive effect on the local economy as well as local housing market conditions. Thanks for visiting RP Data's YouTube channel. Of course, for more detailed information on the housing market, you can visit www.rpdata.com.